Financial, joins us on the programme now. Good morning, Jordan.
Good morning, Greg. Thanks a million for having me on.
No, it's great to have you on. Right, what way are interest rates going to go this year, do you think? No, I mean, now, obviously, I can't see you at this moment, but I presume you don't have a crystal ball or tarot cards, but maybe, I know you have an informed opinion. So what way do you think things are going to go?
Well, you did take the words out of my mouth, Greg. I suppose I don't have a crystal ball with regards to how they're going to go, but there is whispers with regards to them potentially coming down. Now, the reason interest rates went up in the first place was to kind of combat inflation. So obviously everybody's kind of obviously going mad about the price of everything shooting up and skyrocketing, and what governments do in order to combat that is they'll increase interest rates so everything will come back down, so money will become more expensive. Now again, inflation is starting to come down, so there's whispers of interest rates obviously coming down as well to kind of match that. Now again, what kind of people will see here is potentially things like car loans, home improvement loans will start to come.
Yep, Jordan, I use that. Okay, yeah, go ahead.
Like
Sorry, we dropped out there.
Those will come down immediately.
Yep. Sorry, Jordan, you were saying just pick up from car loans and what have you, because you dropped out just briefly there.
Yeah, no, so I suppose with regards to it, Greg, things like car loans and home improvement loans and credit card debt, again, those have become cheaper for people to actually take out those loans. But things like mortgages might necessarily come down immediately. Those are typically a lot slower to decrease.
And talking, I note too, listening to some of the spokespeople for the pillar banks, they're already sort of, I think, trying to prepare the public for what you're talking about there, because they're saying that, whilst they were much higher than the rest of Europe, or much of Europe for a time, Europe did come up a bit quicker than we did, and they're sort of saying that they didn't pass on any increase, although it was from a higher level, and they can't guarantee that any interest rate cuts then will be passed back to the consumer. So they're covering themselves, I think, for this year anyway.
Yeah, no, exactly, Greg. And I think from the perspective, people should also understand that Ireland 2 or 3 years ago was probably one of the most expensive countries in Europe to actually have a mortgage. Now we're somewhere in the middle with regards to how expensive we are to have a mortgage. To think that they drop interest rates, that we'd be one of the lowest countries in Europe to have a mortgage, I don't know, would I be putting my hat on that now, to be honest with you, Greg. Things might just stay the same with regards to interest rates. Interest rates still, in comparison to 20 years ago, like our average rate is around 4.25% at the minute. 20 years ago it was up at 12% in 2004. So again, they still are relatively low.
If there is a European-wide drop in interest rates, and it's not necessarily passed on to existing mortgage holders as quickly as we might like, often we do see the banks sort of trying to target first-time buyers or new mortgage customers. Do you think we might see more competitive rates in that area more quickly?
Yeah, and I think a huge thing, Greg, recently in the last few years is green mortgage rates. So if you have a BER, which is your energy rating, of B3 or higher, typically you'll qualify for what's known as a green energy rating. So again, your house is a lot more robust and warm and sustainable. So in that sense, banks will actually offer you a lower interest rate based on that. So again, I think the best green rate at the moment is with Bank of Ireland at 3.6%.
Obviously, there was a lot of talk of fixing when we were sort of at the bottom of the upward curve, if we could describe it at that, as that, maybe still people are still on variables or whatever it might be. Hopefully no one locked into too high a fixed rate. But is there any argument at the moment for looking at your interest rate fixing or what?
Well, Greg, I suppose from an affordability perspective, I think that's the most important thing people should take into consideration. If you're on a rate of, say, 3.6 to 3.9, and you find it's very affordable for you and your family, and you're happy with that rate going forward, there's nothing bad about locking in for that rate for a prolonged period of time. From a budget perspective, at least and you're consistently happy that your rate will stay the same, because there's not anything saying in the future that rates won't go up either. So I think it's very important to bear that in mind as well. So people need to take into consideration things like affordability, from the importance of how long they should be locking in for as well. Now again, as I said, if you look back historically, rates are still really, really low. So again, it's not the worst thing ever to lock in for a kind of prolonged.
And I really feel for those with the vulture funds with mortgages that have seen them skyrocket. Will they come down at all? We don't know. Well, what is the story with tracker mortgages? I mean, I think people still on a tracker It's not the attractive proposition, I don't think, Jordan, correct me if I'm wrong, as it once was. But people on tracker mortgages might be keeping a closer eye on variations in interest rates, particularly downwards now at this point.
100%, Greg. So with regards to the tracker rate, just to kind of reiterate, that is in line with the European Central Bank rate of interest, and that will fall if the European Central Bank decrease their rates. Okay, so those people are going to be highly affected by this if rates do decrease. So they're kind of sitting on the fence now for a period because they historically would have had a good few years of really, really low interest rates and have been fantastic for those people. And then suddenly over the last 2 years, they've almost skyrocketed. So again, a lot of people are sitting on the fence whether they should come off their tracker and go on to a long-term fixed rate or remain on their tracker and see what happens. And again, when we're talking to clients, Greg, it's always a conversation of affordability. And, if the mortgages become unaffordable for them, they should look elsewhere. If they're happy enough trying to wait it out and see if it goes down. And
finally, is the tracker mortgage a product still? I don't mean for existing customers, but offered to new customers, or is that a thing of the past?
No, not necessarily. So with regards to it, what typically is vast majority of first-time buyers are going on to fixed rates typically. Okay, because again, they're getting onto the market for the first time and they want to kind of have a fixed rate. Variable rates as well are offered to clients as well, but again, typically those are the two you're going to find. You'll have your fixed rate and your variable rate, and those will vary depending on the years that you want to take them out for.
Brilliant stuff, Jordan. Thank you very much indeed. Jordan Mooney of Rockwell Finance, and you can Google that company if you want to speak to Jordan and the team a little further.